Good morning. Welcome to Brownfield's first quarterly livestock or quarterly market outlook webinar series. Today we're joined by University of Missouri Scott Brown, John Anderson with University of Arkansas, and David Widmar with Ag Economic Insights. So as we get things started today, it's kind of a free-for-all in ag economy and livestock and all of the hot topics that have been going on in the ag industry as of late. So as you're watching, whether it's in the webinar itself, you can ask questions. You can also ask questions if you're watching us via Facebook Live, and we'll get those answered as quickly and we'll weave them into our topics of conversations today. So as we get things started, I'm going to let the economists and the experts introduce themselves with a little bit of an opening comment and some opening remarks to get things started. So Scott, let's kick off with you.
Thanks very much, Megan, and thanks for doing this and giving us a chance to talk a little bit about Outlook. So my name is Scott Brown. I've been at the University of Missouri for a little over 3 decades now, doing livestock and dairy outlook and policy work while being at the University of Missouri. Currently doing more administrative work in the Dean's Office in the College of Ag, Food and Natural Resources at the University of Missouri. So as I kind of do my opening comments, there's a lot of different areas one could choose to talk about. I'm going to start on the supply side, however, and kind of leave my comments there this morning. And I like to remind us that, and this is a little 30,000 foot view to get us started, that to me, when I see supply response in the livestock industries, regardless of the commodity, it seems like we've become very unresponsive to low returns or low prices. You think about what's been happening, and I'll take hogs for a minute. You know, the hogs and pigs report, we actually had an increase in breeding inventory from the June report to the September report, which is not how we normally might think about it, and there's seasonality going on. But who would have thought we wouldn't have maybe lost some hog producers in what was a pretty tough financial time? And we just seem to be in a situation where we can't do that. I think similarly for cattle, the same thing exists, maybe to a lesser extent. I start there because I think it just reminds us that we're not going to get supply reduction to get higher prices as we look ahead. If we want higher prices, we have to go focus on the demand side, which offers a heck of a lot more uncertainty in trying to predict where those things go. But if I want to talk about a more positive 2021, I'm going to be focused on the demand side, whether that's domestic demand or international demand, because we're probably going to keep moving similar amounts of beef and pork on the market now. Beef may be in a little better position because we're already starting to cut cow inventory a little bit. But on the hog side, I think we're going to have strong supplies through 2021. And so we better get some pretty good demand strength. So again, thanks for having me on. Look forward to the discussion.
Very much so. Thank you, Scott. David, let's go to you next.
Hi, David Widmar, agricultural economist. Spend most of my time focused on decision making and really the big picture farm economy situation and big picture trends. So a lot's been going on here. And I guess if I could summarize what we've been thinking about, especially when it comes to farm income and this uptick, this large uptick in direct payments and ad hoc direct payments. Are we in unusual times? Yes. Are we in unprecedented times? No. We've seen challenges like this throughout the farm economy in the last several decades. But the implications here is that producers really need to put some emphasis on strategic, sound, and also disciplined management decisions. And so the implications here, we really have to, roll up our sleeves and really dig in deep, because there's a lot of moving pieces, there's a lot of uncertainty, and about the time we get something figured out, it seems like another set of issues creeps up the next quarter or the next year into the future in the planning process. So look forward to the discussion today, and thanks for having me.
And again, for folks who are participating in the webinar and on Facebook Live, you can ask us questions. You can ask the economist questions, and it's open range, and we'll get those weaved in as we can. As we wrap up our opening remarks, John, let's finish up with you.
Can you hear me? Okay. I was getting the message I was muted. I'm John Anderson. I'm a professor and head of the Ag Economics and Agribusiness Department at the University of Arkansas. I've been here since January, so just in time for the wheels to come off of everything. I tell people I think that timing is purely coincidental, at least I hope it is. But my background is as a commodity economist doing marketing and risk management and also policy. I worked for American Farm Bureau for several years, and I've worked in a couple of different land grant systems as an extension economist, and very happy to be here on this webinar today. For my opening comments, I would say I was driving into work the other day, just a day or two ago, and I was listening to the satellite radio, and a Porter Wagoner song came on. You Missouri people, anybody here from West Plains, you know who Porter Wagoner is. He's an old song of Porter Wagoner. I've enjoyed about as much of this as I could stand. And I think that is going to be my theme song for 2020. I have enjoyed about as much of 2020 as I can stand. Unfortunately, we still got a couple of months to go, and it may get more exciting yet before it's over. But it has been an unusual year, to say the least. And I would say I appreciate Scott's comments about the supply side of the market, and I'll follow up on that and talk a little bit about the demand side. And I've really felt inadequate as an economist, I think, for most of this year, because if you would have told me on, say, December 1st, 2019, that we were going to have an influenza-like pandemic in 2020, I don't think I could have predicted the first thing that has happened in 2020 as far as how people have reacted, what the policy response has been, the effects of the shutdown on the market and how that would play out in terms of affecting the dynamics of demand for our commodities. If you'd have given me upfront information, I don't think I would have gone broke trying to trade on it in 2020, because it's been a strange year. But the demand side of the market is still very unsettled. I think Scott's right. The supply side is much less responsive than it used to be. I mean, we're sort of in a world in a lot of our commodities like we've been in with chickens for a long time. If you watch the chicken market, when things get bad, companies will increase production because they think it's the chance to increase market share. So there's, they zig when you think they're going to zag a lot of the time. And I think we're seeing that model applied to other commodities. But the demand side is really going to be interesting going forward. And I think there's maybe as much variability in consumer sentiment out there as I have ever seen. In general, I think consumer sentiment's not great. The latest University of Michigan numbers were down in the 70s on their consumer sentiment index, which is, just for some perspective, we were at about 100 before the pandemic hit. We got down into the mid to high 50s in the Great Recession in 2008, 2009. So we're kind of somewhere in between those 2 points, but not great. Sentiment's really uncertain right now because people are uncertain what is going to happen with COVID-19, what's going to happen with the election, what's going to happen with policy around COVID-19. A lot of our demand for the products we're going to be talking about today is tied to consumption away from home. A lot of places where away from home is still not a great option, and even if it is an option, a lot of people are afraid of it. So the demand side of the market is really giving us a lot of uncertainty. And I think if you couple that with what Scott was saying, where we really are going to be counting on the demand side of the market to kind of pull us forward as we go into 2021 to give us some upside. That makes planning difficult, because the demand side of the market really is very unsettled right now, and fairly hard, in my opinion, fairly hard to game out where we go forward.
So let's start. Perfect timing. We had cattle on feed last week. We also had hogs and pigs. So as we take a look at that, I want to start first with the hogs and pigs report. I thought one of the interesting things that we saw in that report was that the USDA made 0 corrections. There were no adjustments made. And then you take a look at the fact that we're still battling this backlog in the production system from African swine fever. Where does that leave us? And where does that leave the pork sector as we navigate the final quarter of the year, which is typically already pressured on the packer and the processing side? I will free for all. Whoever wants to take this one can grab it.
I'll jump in to start. Go ahead, John.
Well, I will just start with the backlog issue, I think, I've seen some pretty hot reactions to this Hogs and Pigs reports because of the size of the backlog, particularly on those 180 pound and over hogs, those real front end hogs. I think it's worth noting that if you look at the pre-reports, there were a lot of people out there expecting a fairly large backlog. I think the backlog's a little bigger than the pre-reports anticipated, particularly on those sure enough market ready hogs. But the fact that there's a backlog showing up in this report shouldn't surprise us. I mean, the nature of the disruption was such, and even though we've run ahead here for 2 or 3 months in terms of slaughter levels, we really blew a big hole in the market in the early days of this pandemic. And the fact that we're still dealing with a backlog is to me not a huge surprise. And I don't think the market was really surprised by a backlog. I think there's been some pushback about the size of that backlog, but to me, we're kind of quibbling over details there with that. The fact that the backlog is something that we've anticipated. I think it's getting better. I mean, I think, clearly slaughter levels have been such that we are working through the backlog. I like to look at dressed weights on this kind of thing to kind of assess what's happening with currentness, whether we're talking about cattle or hogs. Either one of those weights are looking, a lot better, a lot closer to year ago levels or normal levels. So I think we're getting there. And I do feel like, Megan, you're making a good point that we, it always feels to me in the hog market, like in the fourth quarter, we're sort of racing the clock, right? Can we get through these before we hit those, those capacity constraints? They don't typically get binding, but they get binding enough that we don't like what the market's doing to us. And I always feel like we're in a little bit of a race in the fourth quarter. I think that's going to be more the case this year. But if there's a silver lining to the cloud, I think it's that we'd be in a whole lot worse situation if that big disruption had occurred, a month and a half, 2 months later than it did. We at least have had some time to recover, but it is going to be a little bit of a touchy fourth quarter, I think, more so than normal because of this uncertainty about numbers.
Does it push us into early 2021 to maybe even get current and even further down the road?
I'll let Scott answer that.
So I do think you take hogs and pigs, and especially those heavier weight categories. To me, we actually probably need some 2.7 million head weekly slaughter numbers out of hogs here in this last quarter, just to kind of break even, and some will say even more than that. So the opportunity to continue to whittle away at the backlog, I think, was away here for a period of time. To John's point, we've whittled away at it. We don't know exactly what that backlog's like, but I think we're going to quit whittling away at it, and I think it may take us a little bit into 2021. You couple that with my opening comments that we can't get the supply side to slow down. I think we just have a lot of hogs to deal with here for a while. Mm-hmm. And we talk about all this in the face of what's been higher prices. And frankly, I think markets have been struggling with just how strong could export demand get as some of the trade issues that have come up with things like ASF in Germany have been dominating of late. But to me, it's hard to get through any additional backlog that we have remaining here in this last few months of 2020. And so we shouldn't expect that we wake up on January 1st of 2021 and the world is all great again and it's all perfect for hog producers.
So you bring up African swine fever in Germany, and I think we have to note that it's in the wild boar population, which is a different animal, is less of an issue than if it gets into the domestic herd. How does that come and play into the global demand picture and the global supply picture and the shuffling that we're likely going to continue to see through the next couple of months? David, I'll let you answer that one.
Well, I don't have a whole lot of insights on that, but one of the things that we've been encouraging people to think about is what's the probability of the U.S. having a case of African swine fever? And we've been asking that question for all of 2020, and people have been sharing their expectations. So we're getting to the end of 2020, so the window's closing here, but I think the Germany case opens the door for, okay, we still have risk on the table. What does it look like for the next 12 months, for 2021? And okay, and the big story here is we might be able to see some benefits as U.S. producers, especially on the trade side with the Germany situation. China has blocked or signaled they're going to block imports from Germany. But, you know, the market giveth and the market taketh, right? And so if we have a case in the U.S., we're going to be facing a similar uphill trade story. And so I think that's a huge risk on the table. And I think we got to be always thinking about that as we're making our plans and our decisions is what might happen. And that's going to be a huge question mark. And like John said earlier, I don't really know how the dominoes would start to fall if that starts to happen, right? There's going to be all sorts of, you know, are we going to lose export markets, right? Or will we start losing supply? All these things are sort of up in the air. And that really is a big question mark as to where the dust settles.
So with prices where they are at this point, is there opportunity for producers to mitigate some of that risk if something like that, or protect themselves in the event that something like that would happen here in the US? Because we know it will happen market and trade wise, kind of.
You know, I'll jump in on that and then Scott can correct me. But the difficult thing when you talk about protection on an event like this is timing, right? You know, managing risk when you're not sure about timing is really difficult. And, you know, if you were to take a short position against this, thinking, well, this could happen in the US, I need to take a short position against this. And then 2 weeks later, there's a case in Denmark, and our export business goes crazy because of that. You're on the wrong side of that. So, you know, if you knew the timing, you'd know what to do, right? It becomes trivial. If you don't know the timing, it's really hard to know where to set. And that's especially difficult with things like this. And so my take on things like ASF is, look at, you know, it may do some things that help our prices here and there. Like, you know, when the thing was going on in China, we got some price benefit from that. But overall, that kind of risk is a bad deal for us because it's very difficult to manage and you can end up on the wrong side of it with no warning at any time. This is very analogous to what we saw with BSE back in the early 2000s, right? I mean, we had BSE in Canada, and so Canada was losing all kinds of export business, and then we're picking it up. But then right before Christmas, we get a case, and it all falls apart. So these are the kind of things that can really whipsaw you hard, and those kind of risks I think are really hard to manage because the timing is just completely inscrutable.
So I'll just jump in to say, so number one, John's right on track. However, I think China and ASF versus Germany and ASF remind us that the answer is it depends. If you're going to have ASF in the domestic industry, then you're going to get some probably higher prices. Think about how high pork prices have been in China. Yeah, you're setting where you've had in a boar population, they've lost export markets, but domestic production hasn't frankly been affected by ASF, right? And so it's a drag, I think, lower because they lost export markets with no supply effect. I think here in the United States, we look a lot more like Germany in terms of we've got some wild boar issues here in the United States. It's probably easier for ASF to travel there than it is in our domestic herd. And if that's as far as it gets, it's a different risk than if all of a sudden we have a big domestic outbreak. So to John's point about uncertainty, I just add to it going, I think it's important to understand we might look a lot more like Germany than we look like China if ASF were to travel here. And there's a reason why you find NPPC so focused on, let's make sure we do everything we can to keep ASF out of the United States.
I'm going to switch topics a little bit. Announced yesterday, CME is going to start trading cutouts. How does that impact and what does this do for the pork sector and profitability as well, potentially? David?
I look forward to learning on this question. I'll pass.
Scott, do you want to take this one?
No, I don't. But yes, I'll try to answer a little bit here to get us started. So I think we're all sitting here going, to me, it's a new opportunity, right? It's a new risk management tool. How does it fit in the toolbox? Can I use it as an option to hedge against that pork cutout value that somehow is different than my ability to lay risk off in a lean hog price? I'm not sure what kind of volume we get at the end of the day. We're getting a lot of coordinated activity going on in pork markets generally. So if you could go back to the worst of COVID-19 with the plant slowdowns, was there opportunities to have locked in some pretty high cutout values via the futures market? I assume there was, and we would have seen a lot more of that maybe happen as a different way to lay off risk. I just remind us that those kinds of events are pretty few and far between. But I do think it might give us an opportunity to lay risk off a little differently than we have in the past. So we may see some fairly good volume in that contract as it comes on place. Certainly opening those options give us those additional ability to lay off risk that we haven't had in the past.
I agree with Scott on that, and I'm fascinated by this development actually, and I look forward to seeing how this evolves and how participation in this thing evolves. And I'll tell you, I probably spent too much time in Missouri, Scott. When it comes to new contracts, I have a show me sort of attitude on these new contracts, because I've seen, I'm not a really old guy, but I've seen quite a few contracts come and go that just never stuck. Starting a new contract is really like starting a new business. A lot of them fail very early on, and CME is going to need to see volume on this thing before they'll continue to support it. Some of y'all watching this remember the stocker cattle contract that they put out a few years ago and tried to maintain for 3 or 4 years and finally gave up on it. New futures contracts are not a sure thing. So I personally hope this one really sticks, because I think it's got a lot of potential to benefit the industry as a whole. There are a lot of natural participants, I think, in this contract in terms of risk management. And the idea, I'm sure CME's idea on this is, hey, this is something that the Walmarts and Safeways and Krogers of the world can use to manage their risk on the purchase side. So we'll get some business from them. The packers will hedge their risk on the selling side. And as far as what it means for producers, I think it's going to depend a lot on pricing. And one thing that's intriguing to me, and I think this will relate to the beef industry as well, because we've talked about a beef cutout futures contract for my whole career, and it hasn't happened. But with the risk management tool there that producers would have easy access to, just like any other futures contract, will that change some pricing arrangements? So maybe we see more producer level pricing tied to the wholesale market. And how would that affect both producer risk, their ability to manage that risk, and their overall level of returns? And so this could be a piece of some more significant changes in pricing tools and pricing practices in the industry. Now that's pie in the sky right now, but at least with that tool sitting there, there is maybe some pull to look at how we do pricing more closely tied to the wholesale market. And I think that's the biggest farm level potential implication of this. Will the other market participants jump in and use this thing at volume? I think if it's really going to get the volume to stick, the retailers and the packers are going to have to jump in and use this. Right now, they do a lot of contracting. So what's going to move them from doing a lot of contracting with one another to using the futures contract? I think we'll see. To bottom line it, I do hope it sticks. I think it's got the potential to be a really useful tool for the industry as a whole. I hope the volume's there. Let's see where we are 2 or 3 years from now. Hopefully it's still being traded then.
All right, let's switch gears and talk cattle. There has been a slew of proposed legislation in recent times. For example, Senator Fisher's bill, Senator Tester, Senator Grassley, addressing cattle marketing issues. So where are we, and what are some things that we need to think about and consider as it relates to profitability? John, I'm going to start with you.
Okay, well, I'll start with the legislation and the proposals that are out there. Obviously, this is a hot topic. This is a very live issue right now. There is a lot of interest in seeing some very prescriptive intervention in the fed cattle market to define traded volumes, cash traded volumes of cattle. We'll see where these go. Nothing's going to happen in the short run. We were talking before the webinar got going, with the election bearing down on us and a Supreme Court nomination in play and all kinds of uncertainty going on. I mean, we're talking about what's going to go on next year legislatively, I think, really more than right now. But this is a big development. I mean, this is a kind of a fundamental philosophical issue that we're trying to address here. Is the industry being hurt? However you want to define hurt, is the industry being hurt by the loss of cash pricing arrangements and the large volume that we see of formula pricing? That's what the legislation is attempting to address. And I'll just be honest, I get kind of squeamish about this kind of thing. I grew up in the cattle industry through the 1980s. I came into this business professionally in the early to mid 1990s. And the defining feature of the cattle market in that period of time was practically a free fall in demand for beef, right? I mean, we were losing market share as fast as we could lose it to pork and poultry, particularly chicken. The industry worked really hard in the 1990s and through the 2000s to kind of shore up demand. And a big part of that was improving price signals along the supply chain, particularly from packers to feedlots. And that happened with some really interesting, and I think we have sort of forgotten how innovative those pricing arrangements were. And I'm talking about value-based marketing, grid pricing, however you want to put it. The industry worked really hard to improve the signaling that was going on along the supply chain. And, my concern about legislation that gets too prescriptive, again, not passing judgment on any specific proposals right now, but as a general principle, pricing innovation can be very important to the industry. Being able to evolve in the way we value cattle and the way we communicate value along the supply chain is really, really important. And to me, this is a formative issue. I mean, this was driven home to me very early in my career. If we had not been able to do that in the 1990s, there's no indication that we would have stopped the decline in demand. And so I say that to say I would encourage everybody around this issue to really tread very carefully and think very systematically about how anything we do is going to influence incentives and how it might affect incentives for pricing innovation, because we don't want to lose that ability. I think historically it would have hurt us tremendously to have missed out on the pricing innovation that happened in the 1990s. And so that, to me, is the backdrop that we need to be thinking about when we evaluate this issue.
David?
I think the livestock mandatory reporting legislation it's sort of interesting, right? It's sort of always not under the radar, right? But it was just sort of much easier to pass in the past and historically. And there's sort of a lot of frustration, I guess, out there in the market, and you can really see it in the last few months as all these proposals have came in, and now the livestock mandatory reporting got rolled into the CR bill, which has pushed it, I guess left it in place, but pushed any sort of decision making back into December. And so I think it's just a very it's a very sore spot in the industry, and John's points are spot on, right? A policy is sometimes a series of experiments, and we got to make sure that we're always making improvements, and there's always trade-offs. And so we have some challenges here in 2020, and we got to make sure that we don't hyper-focus on the challenges of 2019 or 2020 when we try to make improvements. We got to take a broader view. So what have we learned over the last 20 years or so, 30 years? And then what improvements do we need to make here in the short run? So it's a big balancing act, and I think there's a lot of attention on that right now. So it's just interesting how this sort of, I've been surprised at how quickly I guess the attention and the spotlight has been shined on this situation over the last almost 12 months.
When we look at that, is there any going back? I mean, if this happens, which may not be in 2020, but if it happens in 2021, what happens if 6 months from that it doesn't work for everybody, or is there a fix if that's the road that the industry ends up going down?
Well, I think you're always going to have folks who are going to try to make modifications as, we take first round of it. If it doesn't work, how do we change it? You can kind of get yourself stuck in that circle of ever changing policy, trying to address the things that you didn't think of with the first round of legislation. So you can find yourself maybe circling around and around trying to get this right. I like to remind us, and number one, for David's point, December is going to be interesting to me for mandatory livestock reporting, because I think you have some folks maybe holding it up, wanting some of this new legislation potentially to be debated more quickly. Could be an interesting time for how we handle some cattle issues. I just want to go back to remind us that this is a lot about price discovery, and people seem to have different definitions of price discovery. The basic economist in me just reminds me that, are the prices that we're seeing reported representative of the underlying supply and demand fundamentals? Let's make sure that we kind of use that as a definition. But too often, I think we got in this where prices were too low during the worst of the COVID-19 because and sometimes I'll hear packers taking advantage of the situation, or I had a feed yard and I had nobody come and visit to bid on my cattle for 5 weeks in a row. Price discovery is broken. And I go, neither of those things are price discovery, by the way. And if you equate price discovery with, I want higher prices for my cattle, I think you're going to be less than thrilled with some of the alternatives that are out there. And I try to say that as generally as I can. However, if we aren't getting good price discovery today, we need to fix it. And I think that we struggle knowing for certain whether we have perfect price discovery when we have a fairly thinly traded market. I think the economists in us remind us that it doesn't take very many transactions to get adequate price discovery, but it's worth a lot of discussion for the cattle industry generally, to have this. Are we getting adequate price discovery given how we're doing it today, or do we need legislative fixes to try to help make for better price discovery?
Is there a non-legislative, I mean, maybe that's a silly question, but is there a non-legislative fix to improve price discovery?
I think there are. If you just think about the issue generally, I mean, if we think enough price discovery is not going on, like the market has gotten too thin, if we think that's the premise, then the fix is to get more cattle traded in some negotiated fashion. Right. And I think there are probably a lot of ways that could be done besides having the government step in and mandate it. I think certainly, let's keep a focus on what it means to fix price discovery. If we assume that it is in fact broken, what all it requires is a bigger volume of transparently negotiated transactions. And so, yeah, I think there are probably a lot of ways that could be done without having the government step in and say, here's how many transparent negotiated transactions we want you to have. But it would take, the difficulty with that is it would take people agreeing to that and working together to make it happen. And we all understand that we're talking about the cattle industry here, which has a long history of not really doing those sort of things on a negotiated cooperative basis. And again, I say that as somebody who has lived and worked and spent my whole life in the industry. So please don't take that as an insult or a negative statement. This is an industry that is fiercely independent, and that serves it well in a lot of ways. But to get a non-mandated, non-legislated solution, it is going to take people agreeing to work together and maybe put to maybe give up a little bit on the self-interest side to do something that they decide voluntarily is good for the industry. So yeah, that's the long answer. The short answer to that long answer is yeah, there are probably a lot of ways that could go about that. It will require quite a bit of cooperation.
So one of the questions that came in from one of the attendees says, are there any concerns or things that producers should think about regarding the Fisher bill setting different negotiating requirements for different regions?
Well, so I'll jump in and say the devil's always in the details here of exactly how you're going to set those regional targets. I think, that bill is probably in response to a lot less negotiated trade occurring in some regions of the U.S. than other regions. I think you have a hard time setting a national trigger when you see where we sit today in the industry. I will at least remind us that when you think about how we see mandatory price reporting happening today, however, there's little incentive for anybody not to report accurately what those trades are. Are they negotiated trades? Are they formula trades? Are they negotiated grid trades? There's no financial incentive to maybe alter that. If you think about some of these bills that are being laid out there, all of a sudden, if I have to negotiate more trade to meet whatever legislative requirement there might be, I may be very innovative in how I want to work with maybe some large feed yards on the other side of this equation. If I'm a packer, to say, you know what, we're going to negotiate these trades, and by the way, the price we end up with is going to look pretty close to the old formula process that we might have done as well. I think those options might actually not help price discovery, by the way. All of a sudden you get in the negotiated side more transactions that might be somewhat disguised negotiated transactions. And so when you legislate these things, I think you have to be very careful about what incentives you create for the industry to work around whatever requirements you're trying to put in place. And again, I'm not trying to say we shouldn't do this. I'm trying to make sure we think about all the consequences that could unfold with that legislative approach.
Another question. Oh, go ahead.
Well, I just want to echo what Scott's saying there. I think that's really important because when we talk about price discovery, again, the quality of information is really important. And right now, I think we pretty much know what we've got in the price report. If it's a negotiated transaction, if it's a formula price, we know that it fits cleanly into that category. But if we change incentives, it would be a fairly simple thing to formally negotiate between packers and feedlots, for instance, and end up every week negotiating that last week's regional price is the price we're going to settle on this week. Well, that's exactly like the formula. So if we end up with prices being miscategorized, we'll have a worse price discovery problem than we've got now because the information won't be reliable. And I think that's what Scott's getting at. I think he's exactly right that it's important that these really be sort of bona fide, genuine transactions that are cleanly described, and maintaining incentive for that sort of transparency is important. Otherwise, we might actually muddy the water when we think we're clearing it up.
Another question from the attendees. The current premium subsidy on LRP insurance is likely large enough to attract some folks who are big enough to use futures and options directly. Any thoughts on how that might impact CME volumes and implications of that? And they also expressed still concern about basis associated with cow-calf producers protecting price on a much lighter weaned calf. So who would like to take that? Scott, I'll let you start.
All right. So thank you. When it's quiet, right? So I think the LRP changes that we've seen are frankly helpful for some smaller producers to do some risk management that maybe haven't been the case in the past. And so seeing some bigger subsidies, I think provides that ability for being able to lock in a few cattle. For those that can handle a full contract, I don't see that much more interest, I guess, in my mind. So I'm not certain that we get a lot more volume. as a result of those changes. It provides help to those smaller producers that otherwise probably don't have many ways to use futures and options to lock in any kind of profit. To the basis question, I think basis is a hard issue here in the cattle industry. And so I'm not sure we have a great way to handle some of the basis risk that sits out there. And I'm not sure anything we've done on LRP necessarily makes that a better situation.
Anybody else? Okay. We're going to switch topics. Let's talk trade. David, I'm going to go to you first. As we talk, what are some opportunities for trade coming up, and what are some things that you're watching from your perspective?
Well, I just want to circle back. Again, John's opening point was really spot on about if you knew the pandemic was coming and you decided to go out and speculate, how you could be wrong or right in both sides. So the one I'm watching the most is the dollar and the exchange rate with respect to the dollar. And right when the pandemic really took off, man, the dollar surged. It really surged against our grain competitors. So the dollar strengthened relative to Mexico. Or it was really strength on the grain side, right? So we had some headwinds against Mexico. We had some headwinds against the Brazilian real. Livestock was a little insulated from that, at least from what I've seen, but the dollar is really sharply higher, especially on the grain side. That was a headwind. Now, over the last few months, the dollar's gone lower, and it's actually lower than it was throughout all of 2019. I haven't checked it in the last week or so, but the dollar has kind of had this whipsaw, right? It went higher and lower, and that's the trouble with things like the pandemic, right? It's hard to know how this is going to fall out, and especially with respect to the timing. But right now, the last few months, we've seen the dollar significantly improve. And I think part of this on the grain side is we've seen a lot of exports taking off. And so I think 2020, the summer of 2020 has been an inflection point for grain exports, especially on the soybeans. We spent the first half of the year noting soybean exports were lagging. China was pretty lackluster in their purchase of soybeans throughout the first 7 months of the year. And now we're in the new marketing year and we're actually setting records. So on a bushel basis, China bought more soybeans and corn than they've really bought this early in the marketing year than we've seen in history, especially on the corn. The corn was really kind of the surprise, at least to me. And it's not only China, it's all of our buying partners, or it's the trade story overall. So we're sending a lot of corn out as well, total corn and total soybeans. And so I think there's been a little bit of a change in that narrative here. That's a good point. Now, I'll add a caveat to that. The USDA had big expectations or big hopes for the grain exports all the way back in the May WASDE report. So we've been living up to expectations. We sort of have been meeting where things are going. And I guess the final point I'll add here broadly that I'm thinking about is a lot of folks have been super focused on will China or will China not meet the phase one trade deal. I don't think that's a relevant factor for producers as they're looking at the markets and their marketing plans over the next year. Where the rubber meets the road is that China has come back as a buyer, and it doesn't matter if it's hitting a certain threshold. Is that they're buying more than they have been in the past and the past 2 years, and now they're starting to buy at levels that we saw pre-trade war. That's the directionality here is really important, and the directionality is up from the last 2 years. The magnitude will be relevant, but I think the biggest part of this story is China's purchases are starting to return. And I think the other point that we need to keep an eye on here is what happens with total exports. We're really focused on total exports of soybeans, total exports of corn, total exports of meats, and total ag exports broadly. From a producer perspective, it doesn't matter if China buys all of those or none of those. What's important is how much of our product is finding a home in the export markets. Now, it might impact the basis as to what markets are going out, but let's not lose sight of the big picture. Is China buying more? Yes. Is that going to impact total exports? I think we need to see how that plays out.
How important is it that they sustain these purchases to that whole picture of, I mean, you mentioned phase one, but the whole trade demand and export market as well? I mean, we know they're purchasing more now, but is it really imperative that they keep the magnitude of these purchases for an extended period of time?
That's a great question. When I look back at it on the grain side, one thing that I like to do is I took all of the grains that China uses and consumes, and what we see here is that in the mid 2000s, their production equaled about what they needed if you kind of netted all those grains out. Right now, they have about 100 million acre gap, and so over the last 15 years, they've been relying on the world for more of their grains and their row crops, and that's sort of the big trend. And I guess the question that I have is, how long does that trend continue? And are they going to continue to be buying more of this stuff? And then the second part is how much of a role does the U.S. play in that? The concern I had about the trade war is that we might have seen China's long-term story start to tail off. They might not see a growth in exports continue. They might slow that growth, or they're going to rely on other partners to meet those needs. So now the trade war might be behind us. Does China continue that growth, and does the U.S. remain a viable partner into that? I think that's the unknown here. And so the China story to me is still has several years to it. We still have several years of information or of data that we got to play out here. I think they're going to continue to be a significant buyer into the future.
John, any your thoughts on trade overall? Grains, livestock, olive, ag, goods and services?
Well, I go back to what Scott started with, I think, about the importance of the demand side to the markets in 2021 and to getting recovery, getting kind of healed up from the disruptions of 2020. The exports for all of our major commodities, I think, are going to be an important component of that demand. I think it's encouraging what we've seen so far, what David was just talking about with respect to China. And I do think it's important that we not, to your previous question, Megan, not get too focused on short run changes. I mean, we're going to see, China's going to be a strong buyer early in the marketing year, and they're going to tail off. I think that David's focus on rate of change is very well placed. Let's look at how we're changing relative to previous years for a particular point in the marketing year. Are we seeing growth? Are we stagnating? But yeah, we'll tail off as we go through the marketing year, but how are we looking compared to a year ago? What's that rate of change looking like? And will we continue to see that rate of change, that steady state growth going forward? I think that's going to be important. But for all of our commodities, exports have become a key component of demand. It's going to be a huge deal for the pork industry. It is obviously now, but maintaining that strong export market as we kind of go through this slug of hogs that we've got to get through sometime out there into 2021, we're going to need to see strong export markets. And so it is a double-edged sword. And I think we all know that in agriculture, exports can contribute greatly to demand growth, but they do leave you open to vulnerabilities if that bigger portion of your demand is subject to disruptions that the domestic demand isn't a lot of the times. Think of your sanitary and phytosanitary issues that come up and whatnot. So we need it. We need to see it continue to grow. I'm encouraged by what I'm seeing so far. It does create additional risk that we'll have to be aware of and thinking through how to manage as we move forward.
So Scott, I'm going to throw a question at you from one of the viewers. Does China's aggressive corn buying suggest a huge 8-month supply in ending stocks projected in the supply and demand report may not exist, especially in light of the fact that they're now only rebuilding a decimated hog herd?
Can I get you to actually repeat that question for me, Megan? Because you faded out on me just a bit, so I didn't hear enough of it to respond.
Does China's aggressive corn buying suggest the huge 8-month supply and ending stocks projected in the supply and demand report may not exist, especially in light of the fact they're now only rebuilding their decimated hog herd?
So maybe, so I go, China's always that wild card for us. So it's hard for me to answer very specifically that question. You know, my concern all along related to China has been more longer term. Are we a reliable, do we become a reliable supplier to them? When I look at hogs in particular, you know, I think we're already starting to see the stories come back out of China of we want to be self-sufficient or near self-sufficient in terms of pork production. If that's true, that changes the mix of things. So to me, do we ship pork to China? Do we ship corn to China? If I'm a corn producer, I may be okay with us shipping a lot of pork to China as well. It's still corn in disguise in many ways in terms of just more domestic use. But if I'm a pork producer, I worry a lot about this. So strategy for China longer term matters a lot in terms of where they want to be. So I guess in my mind, I think the Chinese are going to try as hard as they can to build that pork herd back. I think when you see what's already been happening, it's been slow recovery. It may be fits and starts as they deal with ASF there again, but I see more and more they're going to try to grow that domestic pork industry back, and that probably bodes well for us in terms of our ability to export more corn and soybeans.
So we have
Megan, let me jump in on that. I agree with Scott's answer. I think that's a great question, though, and I want to point out I would never assume that just because China is buying aggressively that means they're short on supplies. They do things like that sometimes. I mean, look at what they did a few years ago with cotton and accumulated massive cotton stocks that hung over the world market for years. But they bought into those stocks over a long period of time. So the fact they're aggressively buying now doesn't necessarily mean that stocks aren't there, that number is in error, and that's kind of what I see in the nature of that question. Could be, but I wouldn't bet on it. They have other reasons for buying, particularly now with the pressure I think they feel to carry through on phase one. I think that adds some additional pressure for them to buy, even though they may have stocks. So I think that 8 months supply in ending stocks may well be right, and they're still buying aggressively anyway for other reasons. They've done that kind of thing before.
So there's a whole lot of things we didn't get to as we're wrapping up. I do want to talk a little bit. You've all have mentioned we are in an election year. We're just a few weeks away from an election. How does that impact a lot of different things that relates to the ag economy, whether it's proposed legislation, whether it's thinking about the focus of the potential administration or a carryover of this administration? How does that weigh on the ag sector, and what are some things that farmers and producers should be asking themselves right now?
Well, I think a couple things one can look at here. Number one, what happens to direct support to agriculture post-election? We talk about CFAP and CFAP 2.0 as we've pumped a significant amount of government assistance to agriculture this year, trying to help through the COVID-19 situation. What's the political realities of, do we need more stimulus, direct stimulus, number one, going to agriculture? And if the answer to that is yes, how does the politics play out to get future rounds done? I think all those things are pretty open and depends on what happens in elections. Number two, and maybe this is more for me thinking about domestic demand for meat products in particular. You know, we have a pretty significant downturn in the economy that has resulted from COVID-19. And frankly, it's been masked in terms of what I've seen from domestic demand for meat products. And I think that's associated as well with other stimulus programs that have put more dollars in consumers' pockets that they've chosen to spend on meat products. Do we get beyond this election and the general economy downturn catch up with us and create a pretty negative domestic demand outlook into 2021? And can we deal with that? Or are we going to what are the politics of providing more stimulus more generally to the economy? So we certainly have, I think even this week, Congress trying to say we may do another round of stimulus. Whether we can get that to the finish line in the middle of what's really election season, I would guess that's a pretty hard and tall task to make happen. Is it any better after the election in terms of if we need more stimulus in the general economy, can we do it? Do we finally decide some of the debt that we're building up right now doing all of this stimulus matters? There's a lot of questions, but I don't see any of it only potentially having some downside effects to domestic demand for many of our meat products. And so I'm really curious to watch that unfold. And it's probably my biggest downside risk that I see coming in markets is that domestic demand dries up for many of our ag commodities in early 2021, and that creates issues for us.
John?
This is this is another one of those things like the pandemic. If you told me how the election was going to go right now, I'm not sure I would know how to trade on that information. The election right now is creating a lot of uncertainty. That uncertainty will be resolved. That's the great thing about elections. We sort of have a date certain for when it'll be resolved, or hopefully within a month or so of that this year. We'll see. In terms of ag policy, we go through this every election cycle. I mean, when there's a strong possibility of a kind of a regime change, a flip from R to D or D to R, we talk a lot about what that means for ag policy. And again, I'm thinking here, let's zero in on kind of farm bill policy, which we hadn't talked about a whole lot. I do think if we switch from a Republican to a Democrat administration, we should expect to see a different emphasis in policy, a different emphasis in philosophy around that policy. I think my expectation would be that we would see probably obviously continued support at some level, but probably more strings attached to that support related to things like conservation measures, environmental compliance, what have you. I mean, again, I'm talking from general principles here, not anything specific, but those are the kind of conversations I think that have been had around both of these administrations. So I would expect more emphasis on those kind of things, maybe more of a focus on insurance and less on direct payments. If we do see a shift to the Ds, but all these things are contingent. If the White House flips and Congress doesn't, what is that going to mean in terms of negotiations? So there's still, it's really hard for me to game out exactly what this means for policy, but I would fall back on my general principles that a Democratic administration is going to be more focused on probably on crop insurance, on small farm kind of programs, on conservation, environmental kind of programs, and less on some of the direct support stuff that we've had over the last couple of years. To Scott's point about demand, I think that's a good one. When the further we are from an election year, I think the less likely we are to see stimulus. And again, that's a general principle. And so after November, we'll be pretty far to the next major election. So I think stimulus is less likely. I do think we may have some buffer in the market. If you look at the personal income reports, monthly, the savings rate has just been phenomenal. Really since the pandemic started, partly because there's nowhere to go spend money and you can't leave your house. But a lot of this stimulus money, I think, has been banked, which will give us some buffer, I think, that will carry into 2021. Now, as long as we're in an uncertain environment, people may still be unwilling to spend. But I'm cautiously optimistic that we can weather a drop in direct support because of what's been banked from this past summer. But that's something I'll be keeping an eye on as we roll forward after the election for sure.
David, we'll finish up with you.
Well, I definitely agree with John and Scott's points. On the domestic demand side, look at what happened with meat consumption after the Great Recession, right? We saw multiple years of contraction. It wasn't just the one out the gate, right? It was multiple years of adjustments that happened, especially for beef, right? And it took a while to get that adjustment to take place. Now, what's different here with the pandemic is it's very rare that the stimulus takes place at the same time as the economy slows down. And so with the pandemic, we got the signal right away, right? We knew exactly when the economy shutdown started. And so the stimulus came very early. So if you think back to the Great Recession, the economy sputtered at about the same time, early spring, January. I think the recession actually started in February or March back in 2008, and we didn't get the recessions until late in the fall, or we didn't get the stimulus until late in the fall. Well, we got the stimulus here in pretty early in the spring, so we have a big question mark as to how all this is going to unfold at the individual, at the consumer, at the person level. When we think about the politics of the situation, a lot of conversation about the individuals, and I think that's definitely warranted. John's comments were really important, but I think it's also important to scale back just a little bit and just look at the political environment or the political realities. And the reality is the farm economy has been propped up over the last 3 years, really, by an uptick of ad hoc direct payments. And we've been treading water. The financial balance sheets are in an okay but stable place, and it's because of those ad hoc payments. And there's a lot of attention right now. We're going to set an inflation-adjusted record high for direct payments in 2020, and that puts a whole lot of attention on the farm economy. I don't think the political appetite for supporting that level into 2021 or 2022 is going to be there, regardless of how the administration plays out. So I think we got to think about that as well. Another lesson from the Great Recession is the impacts can last a long time. So we had sequestration on ARC and PLC payments that lasted many, many years, way beyond that 2014 farm bill. I believe the 2019 received payments that were on 2018 production were still under the sequestration rules. That was a decade after the recession. And so we're going to go into a political reality where we're going to have record deficits, record spending, and now Congress and the political reality is we got to figure out how we're going to deal with an economy over the next decade that's going to be saddled with all these realities. So the spending appetite, again, is not going to be there. And finally, I think John's point was really spot on. Producers have got to think about how might there be a shift in the type of programs, and the shift in the type of programs could be important to consider. And I think, again, this is going to be regardless of whoever's in administration. I think that there's going to have to be a shift in these programs. ARC and PLC are not as effective today as they were in 2014 and 2015. And I think whenever that farm bill negotiation comes up, those programs are going to be heavily under the spotlight from both parties, from both sides of the spectrum when we get to that. So a lot of uncertainty. And I think I learned a lot about timing in this situation. I've been wrong on the timing, but I'm pretty confident to say we have a decades long political reality that got set by the actions that we've seen over the last 9 months. And that's just going to be something we got to sled through.
Anybody else? Anything else? Scott, are you?
Surely somebody has a positive spin. I kind of took a negative outlook.
So how about we do this? We have, you've been so gracious with your time today, and we appreciate all of the comments. As we kind of wind things down today, how about we close out with an outlook and some closing comments as we look ahead through the end of 2020 and we jumpstart into 2021. Scott, we'll start with you.
So my crystal ball's pretty cracked and broken these days. So trying to do outlook even between now and the end of the year, I get a little cautious about. I always will say I'm worried about the downside risk in these markets. I'll take Hogs to begin with here as we kind of close. I will say I think there have been some good opportunities to do some risk management on the Hog side that we didn't anticipate coming as a result of things like ASF in Germany. I sure hope folks are thinking about those opportunities, because the supply side is going to be pretty heavy between now and the end of the year. On the cattle side of the equation, I do think we have some opportunity for prices to maybe be higher. So I guess I'm less worried about the supply side driving cattle prices lower as we finish 2020. I can be optimistic as I get into early 2021 that we're going to be in a better situation than we were in 2020. However, I say that not knowing exactly how COVID-19 continues to play out. We get into the winter months. You know, if we were to talk about something that seriously locked down restaurant trade yet again, all bets are off. So I keep trying to say the downside risk worries me in the markets, although generally I can be a little optimistic about where we head as we get into early 2021.
John, I'll go to you next.
Yeah, I would say this is a terrible time to do Outlook. This is maybe the worst time to do Outlook I've ever seen in my life. Right? I don't feel like I know anything. So take everything I say with a huge grain of salt. You know, I'm cautiously optimistic on the market fundamental side of things, you know, particularly about cattle. I do think that the cycle is turning in our favor. We've had a bad year. It's been a rough year and people have hurt. There's no question about that. I do think the fundamentals are going to become much more supportive as we look ahead over the next couple of years. And so I think we've got some opportunities there for some decent markets moving ahead just because of, again, normal fundamentals. I think if you look at the major commodity side, the major crop commodity side, the demand side of the market globally has looked pretty good. We've talked about China and those exports. That's a big deal. We will get more, even if we get gradual recovery in the economy, the domestic demand side is going to start to look better. So I think there's some real upside there, which, you know, there ought to be after the hit we've taken this year. Usually, you know, the closer you are to the bottom, the more upside there is. Just, and again, I'm speaking from general principles here. So we've gotten pretty close to the bottom in 2020, I hope. So I think we can look at a lot of our commodities and see some upside. I don't think, though, that I've ever in my life seen greater policy risk than we see right now. And policy risk is a real issue. You know, what is going to happen with our policy related to trade? What is going to go on? And again, for you crop guys out there listening, what are we going to see with our farm programs? The ad hoc money has really covered a lot of problems up over the last 2 or 3 years. And keep this in mind as we look ahead in terms of outlook, looking ahead to the next policy process related to the Farm Bill. That money won't be in the baseline. You know, we've got ARC and PLC in the baseline. That's not going to be very exciting for anybody. So how do we build programs around that in an environment when the political sides are at each other's throats? So the policy risk is pretty severe out there right now. You know, we have, hopefully as we move to 2021, we'll get to a less dysfunctional policy environment than we're in right now. But I mean, frankly, to me, it looks pretty ugly right now. And my biggest concern as I look at markets, I think supply and demand fundamentals are moving in a generally positive direction for our major commodities, but the policy risk, which is to me the most unpredictable of risks, is pretty severe right now.
David, we'll go to you for final thoughts.
Again, I don't disagree with anything John and Scott have said. In fact, I wholeheartedly agree, especially what John said there at the end. I think there's some positive stories starting to emerge, but there are huge clouds of uncertainty on the horizon, and they're going to stay there, in my mind, for quite a while. So what do I recommend to producers is, first off, focus on what you know today and focus on knowing where you are today and focus on the realities of the situations. Don't get too caught up in the far off distance. That's important, but we also got to know what's going on here today. And so for a lot of folks, these ad hoc payments, especially in 2020, are going to be a bit of an opportunity to shore up some financial conditions. And so use that as an opportunity. Be very strategic and disciplined as how we might be using some potential financial improvements that our balance sheets are going to see. Again, that's not going to be the case for every operator, but I think there are going to be some opportunities here to really make sure we're doing a good job there because of all the unknowns into 2021. And when it comes to the unknowns into 2021, focus on base hits. This is a time in the agricultural production cycle where we got to focus on base hits. This is not a scenario like we saw in 2010 when we knew that there was this big supply boom on the horizon with ethanol in China. This is not that's the time when you swing for the fences. Today's reality is you focus on the base hits. So know where you are today, focus on the base hits, and take advantage of opportunities when you see them, and use your risk management plan to make sure that you can continue to stay in the game.
Gentlemen, again, thank you so much for your time today. Such great information available to us and that you've shared. And we appreciate you being in our lineup for our first in this quarterly market outlook webinar series. So for those of you watching, if you want to find out more information or you want to see any of the other webinars we've hosted, go to brownfieldagnews.com. Brownfield TV has a bunch of great videos and conversations about agriculture and what's been going on. Have a great day. I'm Megan Grebner for Brownfield.